Welcome to Finance in 5. On the back of a previous video looking at Michael Burry's investment in men's suit company Tailored Brands, I've been asked to give my take on Burry's investment in another company, Gamestop. So today we're going to look at Gamestop, Burry's approach to and philosophy behind investing in it, and how investing in it could set you up for big wins. Coming up today on Finance in 5. This is a retailer of pre-owned games consoles, hardware, games and other accessories, which Burry sees as a bargain amongst the refuse. Like Tailored Brands, its stock price has collapsed. Throughout 2019, Burry held and sold various portions of the stock and recently topped up Scion Capital's holdings. The popular perception is that GameStop is an absolutely awful, dreadful, horrifying, despicable company. Why do people think that? Well, just look at its share price, 85% lower now than at its 2008 peak. Lots of small brick and mortar stores, dwindling profits because everybody's moving to digital gaming, declining business model, overpriced games. It's just another Blockbusters or Toys R Us, people say. Well, the management has been criticised by Burry no less for overspending. And the company is poorly adapted, many people say, to changing customer demands. All of that might be true. However, Michael Burry still sees this as an attractive investment, as the Big Short investor owns in excess of 3 million shares and 5% of the company at the time of this recording. So let's delve into why. Here are 5 reasons why I think that Michael Burry likes GameStop.
I look for value wherever it can be found.
It was GameStop's inability to control costs that has hurt the profitability of the company far more than the shift to digital. For example, 2019 compared to 2013 shows a revenue decline of only 6.8%, with gross profit down 13.9%. Interestingly, gross profit at GameStop increased for 5 consecutive years prior to last year.
It's only a matter of time before someone else sees this investment. We have to act now.
From a revenue and even gross profit perspective, this is hardly a business that is in a major decline. Here we see that when a range of consoles was brought onto the market, the GameStop share price rose in tandem with those releases. It wasn't necessarily an immediate spike upwards in each case, although the peaks do correspond to the highest frequencies of new console purchases, roughly speaking. Despite the growth in digital market share, this augurs well for the GME share price once the PS5 and Xbox X Series become available later this year. The current fiscal year is bad, there's no question of that, and a lot of businesses are tanking right now, but it might be more helpful if we were to focus on the trap of comparing the upcoming console cycle with the previous console cycle.
Michael? Michael?
Yes?
Is everything okay?
Yes, honey.
Sure?
Yeah, baby. I'm fine.
Those people who are bearish on GameStop suggest that the next console cycle will not save the company because the shift to digital is killing GameStop. It is true, GameStop performed much better in 2012 compared with 2019, but a big reason for that is due to GameStop's other segments. So let's look at the sales figures. In the fourth quarter of 2012, GameStop's same-store sales actually only decreased 4.6%. But that's because GameStop had a 60.3% growth in digital receipts and $100 million of mobile sales, offsetting weaknesses in the core business. 2012 also had a 53rd week, and when over 40% of sales occur in the final quarter of the year, those additional shopping days do have a large impact. If you exclude the 53rd week, sales would have fallen to $8 billion for a decline of over 11%, with a same-store decline of 12%. Are 2019 same-store sales worse than those of 2012? Yes, they are. However, a 7 to 8 point difference in same-store sales is a lot different than a 12-point difference. Is digital responsible for the extra 5 points? I believe there's an argument to be made that the sale of pre-owned consoles and games is likely to be a lot more popular during a Great Recession compared with the Great Boom, but the jury's still out. One key reason why growth wasn't even better in 2013 and 2014 was that the Sony PS4 was not backwards compatible. Sony has confirmed that at a minimum, the PS5 will be backwards compatible with the PS4. What does this mean? It means that people can play games from earlier versions of the same console on the new model, PS4 games on the PS5, for instance. They can sell their old games to GameStop, and GameStop can sell those on to newly minted owners of the PS5 or Xbox Series X, which are both set for release in the fourth quarter of 2020. Rumours are that the confirmed Xbox Series X will be backwards compatible with the Xbox One. Have no doubt, backwards compatibility is not only key to pre-owned sales, but it also provides even more incentive to purchase a new console. If a person can buy a used game from 2003 and use it on a 2020 PS5, or play Halo or Grand Theft Auto or Assassin's Creed on the new Xbox Series X, that's going to interest a lot of people, and incidental purchases of older classic titles are certain to perk up. The idea that the last console cycle only led to a 3.8% increase in same-store sales is really at the crux of the argument that GameStop is about to collapse. Bearish people believe that the last console cycle didn't result in a major increase to the new software sales or pre-owned sales, so why should it save GameStop this time around? It's a reasonable argument until you delve a little bit deeper. Firstly, when the mobile and consumer electronics and 53rd week data are considered, we see that they helped to moderate the decline of the core business back in 2012 and made the numbers in 2012 look much higher than the years that followed, which resulted in a moderation of the growth of the core business in 2013 and 2014. Strip this data out and we would nearly have doubled the same-store sales growth from the 3.8% that was actually reported. We must force ourselves to think critically about why the sale of a console is important to a retailer like GameStop. Well, for every console that GameStop sells, several things happen. Number one, they have the potential to persuade that customer to become a PowerUp Rewards member. The PowerUp Rewards program was launched in 2010. Here are the annual membership numbers as of the end of each fiscal year. There will be those who say, GameStop's a total rip-off. I'd rather just order the same thing off Amazon or Best Buy and save myself $25 to $35 a game, which is a perfectly logical and sensible perspective. I'm simply telling you that millions of people have become PowerUp Rewards members with GameStop and that the numbers are the numbers. Those customers are likely to buy new and used accessories for the hardware, they're going to purchase new software for the hardware, and if the new hardware is backwards compatible, everything they purchase will deliver a higher profit margin for GameStop.
Well, just take a beat. We'll talk about this later.
Lawrence,
okay?
please don't patronize me.
So the next generation of consoles is going to boost pre-owned in a way that the previous generation couldn't. Digital sales might be going up, but the existence of all the previous physical games will create a bottom in the pre-owned category. And that's all very nice, but how are these points relevant? Well, let's take a look at the console declines. GameStop bears, they think the console cycle won't help GameStop in 2020 because an increase in hardware revenue didn't help them that much in 2013. And yes, we've already established the benefit to GameStop is selling consoles, not only as many as possible, but also because you get incidental purchases of other items. This table reveals that we have seen a complete drop in sales of consoles between 2008 and 2019. They've fallen over 50%. Digital has hurt GameStop, but it's the decline in console sales combined with the mismanagement of the store footprint that's the real reason for its decline. The 2020 console will be nothing like the 2013 console cycle. The launch of the PS5 and the Xbox Series X will be game-changing, and the annual unit sales of these consoles will very likely top 20 million a year in the United States, without question. These are revolutionary, top-of-the-line products that are very different from the previous launch. In fact, back in 2014, you can research this for yourself, there were many articles questioning why the console sales were so poor. One article pointed out, the PS4 and Xbox One is the first generation to have technology that's worse than what is already out there. There are 2-plus-year-old GPUs that outperform these boxes, and even budget GPUs now in the $150 range outclass these machines. If you buy the highest end GPU on the market now, you have almost 3 times the performance of these machines. And we are not even at the start of the generation. This is unprecedented. The PS4 and Xbox One were not revolutionary consoles. They were reviewed scathingly by many commentators in the field. They were not backwards compatible, they were not powerful, they did not have top-of-the-line graphics. The next generation of consoles are completely different, and once they are officially revealed, we're going to discover even more reasons why they're going to fly off the shelves. The PlayStation 5 will run off a custom-built version of the third generation AMD Ryzen chipset, packing in 8 cores with the company's new Zen 2 architecture and Navi graphics. It's a system that will be able to support ray tracing, a performance-intensive lighting technique that has previously been the reserve of expensive high-end PC GPUs, and which we now know will be built into the GPU hardware for the PS5. Sony has also talked of the console setting a new gold standard in immersive 3D audio, particularly for those using a headset while playing. Some leaked patents, too, show off some intense ventilation design for handling all of that processing power. The PS5 will also support screen resolutions of up to 8K for higher than standard 1080p HD of most people's televisions, let alone that of the increasingly popular 4K. It'll also work at 120Hz refresh rates, allowing for super smooth movement in games. These are incredibly performance-intensive specifications, so we wouldn't expect a game to hit these standards regularly, not to mention requiring an expensive TV that will support them, but it's good to see what Sony is aiming at. Perhaps the most interesting element of the Sony build is its commitment to using SSD storage. The solid-state drive in the PlayStation 5 will again be a custom-built piece of hardware, and Sony has already been showing off its technical prowess with a demo of its existing Spider-Man PS4 game. On PS5 hardware, the game is able to race around an incredibly detailed New York City at ridiculously high speeds without any delay in geometry loading or texture streaming, something that would never have been possible on the PS4. We've got some new tidbits on the next DualShock controller as well, though there's currently no official branding. A blog post by PlayStation said that haptic feedback technology would replace last-gen rumble features, while adaptive triggers will be able to recreate different levels of resistance for different weapon loadouts or types of terrain that you might be navigating in-game. There are a few key pieces of data here as well. Specifically, these are incredibly performance-intensive specifications. When people see what these games actually offer, they're going to want to buy the consoles. Furthermore, the size of these games are going to be massive, which means that physical versions may gain in popularity or at least stabilize in the short term. Secondly, note that the controllers may also be revolutionary. Does anybody know when the rumble technology in the DualShock controller first came to America? May 1998, so it's over 22 years old. With the new controllers, users are going to feel the actual sensation of pulling back an arrow on a bow, combined with the immersive 3D audio. By the way, lack of an audio upgrade from the PS3 to the PS4 was a major complaint. People are also going to want the new controller, which means massive accessory sales for GameStop, so Burry is onto something with this investment. Digital gaming might be popular, but top-of-the-line accessories such as these will be in demand, which will be met by GameStop supply. 2017 was a blip, the only year in the past 12 years that annual console sales at GameStop in America actually increased. Why? Due to the March 3rd, 2017 release of the Nintendo Switch. How did it impact GameStop? Well, sales of video game hardware increased 28.3%. So just imagine what's going to happen if we go from 13 million consoles sold in a year in America to 20 million consoles for the next couple of years. This is why I share Burry's view that things could spike upwards in short order for GameStop. Perhaps GameStop bears will attack me here and try to point out that pre-owned still fell 4.6% in 2017. Yes, that's true, it did. But the Nintendo Switch was a brand new console with no pre-owned library of games. This is precisely why the PS4 and Xbox One did not help GameStop in this category back in 2013, and precisely why 2020 and 2021 will be different. GameStop owns tangible assets which it uses for its operations, including 2 warehouses and a headquarters in Grapevine, Texas, appraised at over $34 million. They also have a corporate jet appraised at over $13 million. In GameStop's last 10K, they also list property in Canada, Australia, and Italy, totaling 427,000 square feet. While we do not know GameStop's current market cap, as we're unaware how many shares have been repurchased this quarter, it's definitely below $250 million. Therefore, we can definitely say that GameStop's real estate holdings and corporate jet currently represent at least 20% of the current market cap of GameStop. We also know that GameStop ended Q4 of 2019 with more cash than debt. Finally, we know the inventory is valued at cost, and pre-owned has the highest margins, about 43% in 2018, which means even accounting for inventory shrinkage, GameStop's inventory is worth a lot more than what is listed on the balance sheet. Why? because it hardly has to pay anything to take it off people's hands. GameStop has just over $400 million in long-term debt that is due in 2021. However, it's possible that GameStop may have repurchased debt in addition to shares during the last quarter. If GameStop was to refinance its debt, it would absolutely crush all of the short sellers betting against GameStop. Others have questioned whether or not GameStop could refinance. They've suggested that they might have to offer interest rates of over 10%. In my particular view, that's ridiculous. GameStop's bonds mature in 2021 and yield 6.75%. So there's absolutely no reason why GameStop should have any issues trying to refinance the current debt, either through a new offering or an exchange. Given that the current market, they might even be able to lower their interest rate. According to the Wall Street Journal, there are currently 65.16 million shares short on GameStop, which is likely greater than the actual number of shares outstanding, and most certainly greater than the public float. Additionally, the interest rate that short sellers are paying to short the stock are absolutely extraordinary. If the debt's refinanced, there's zero chance of GameStop going bankrupt anytime soon, even if bulls are completely wrong about the popularity of the new consoles. That scenario could lead to a massive short squeeze that could lift GameStop's share price to extraordinary heights. So what's the conclusion? The bull case for GameStop is strong. It goes well beyond debunking the 2013 console cycle myth as it pertains to GameStop's sales figures. GameStop has a very strong balance sheet. They've repurchased a significant number of their shares. They've embarked upon a significant cost-cutting strategy, which includes de-densifying the store base, and short sellers have put themselves in a dangerous position. Additionally, GameStop has significant real estate assets and significantly undervalued inventory. A debt refinance, a new share repurchase plan, or a proxy battle could result in massive and historic short squeezes. In regards to the de-densification process, it should be noted that in the 2012 annual report, GameStop mentioned they would be closing 81 stores, and that using the PowerUp Rewards database, they had a unique sales transfer process where over 40% of the sales could be transferred to an existing store nearby, resulting in an increased combined profit of 20% or more. Since 2012, the PowerUp Rewards members have doubled, while the profitability of stores has fallen. So in other words, it's likely that now an even greater number of sales can be transferred, and the combined profit will be significantly higher than 20%, since the lease of the stores that are closing is probably a lot bigger percentage of the total cost than it was back in 2012. So my particular view is that this company is going to do well. All that rambling, what do I mean? What's the key takeaway? The key takeaway is that this console cycle is coming out later in the year. We've got Xbox X Series and PS5 being released. If I were you, I would lock in at bargain price some shares in GameStop, knowing that they are going to be selling the accessories that the new gamers, and it could be 20 million of them in a year. At a bare minimum, there will be 3 to 5 million PS5 and Xbox Series X consoles sold all around the world before the end of the fourth quarter of 2020. And it's impossible for GameStop's share price not to go up massively just as a result of that. Even if you think that after this console cycle, the company's done for and is going to tank, fine, maybe it is. But my particular view is that it's going to spike upwards in the days and weeks, well, preceding the release of the consoles and probably immediately after. So I would definitely, for all of the reasons that I've talked about, people will be buying old titles to use on the new consoles. People are going to be buying the new controllers to use with the PS5. People are going to be trading in their old consoles to get money to be able to actually buy the new ones. From the oscillating nature of the share price, we can see that it rises and falls depending on which consoles are released and when. So why would you know this information and then not capitalize on it? If there's a possibility that you can make a massive amount of money, why does GameStop comprise such a disproportionately large percentage of Burry's overall portfolio? It's because he's done the work, he's looked at the numbers, and he's concluded that it's going to make his shareholders and Scion Capital very rich. Maybe he will sell after it spikes upwards. He's already done that once, like last year, but the fact remains this company looks like it could succeed. Anyway, let me know what you think. Is it going to go up? Is it going to go down? Is it going to stay the same? Is it done for? Tell me your thoughts and look forward to seeing you soon. Thanks for listening. All the best.